Good morning, ladies and gentlemen. Well, we've had a very quiet start to the year, so Happy New Year. And we're also going to have a holiday shortened week because of the Carter burial, and we are at crucial levels in the term premium and also in real rates. We are making new highs in term premium, and we are very close to taking out these secondary highs and going and trading around the 255 area in the real yields. The bond market just doesn't want to know about holding any bid, and that to me is very dangerous, because what the bond market tends to do is spike levels, and I think that a spike of this 255 previous high in real rates is going to have some very bad consequences for all assets. So I am on the watch out for that, and I have to know what I'm going to do at 255 and above. I still think that if we zoom this chart out, we can see that 275 or so was the high throughout for the past 25 years. 283, whatever that is, but it's certainly sub 3%. This chart is looking very dangerous, isn't it? I mean, we've tried the lows, didn't work. I think that we try the highs over the course of the next couple of months. But it's going to all depend on the Trump policies, I think. If the policies come out as inflationary, you will see a spike in real rates and certainly a spike in term premium. Term premium are going to spike a lot more than real rates. And that, should be enough to get some kind of response from the stock market. But from those levels, with the term premium as high as they will be, and also real rates as high as they will be, it should be an investor's paradise for the next couple of years. So let's have a look at what the yield curve did the first few days of the year. Well, it keeps on steepening. This is 2s10s, and I guess we are going to minus 42. If we look at 2s30s, they're continuing to steepen. They're testing the previous lows. After those previous lows, we have minus 81, and that is going to be a massive level. That should coincide with new highs in term premium and new highs in real rates. If we look at 5s30s, that is what we're seeing. We're seeing rolling over. I think that this area will trade. That's minus 53 to minus 67, and if we roll out, we can see how long it takes to break that level. So at this area, I think 5s30s are done. Minus 53 to minus 67, I really don't see why we should go through there. And if we look at 10s30s, which is almost pure term premium, I think that we will go and retest these areas from minus 29 to minus 35, and that should be all she wrote for the time being. If we start spiking through there, I really don't know what to tell you. Things are a lot worse than they look in that case. I just can't see why that would happen at the moment. So the real question is, are we done in terms of Fed easing? Are we done in terms of reaching neutral rates? Who the hell knows? But the curve is telling us that the probability is getting there. If we have nothing much to look forward to from the Fed, if rates are going to be pretty much stuck for a considerable period of time at these levels, and if you examine closely what Powell said during his presser and what the noises have been from the Fed speakers, that could be absolutely what is going to happen. i.e. they're now going to wait and see what the policies of the Trump administration are, how the market interprets them, and what the effects on data they have. Well, the effects on data is going to be months, isn't it? The market might react very quickly to them, but the effects on data are not going to be seen for, what, a quarter? So it's entirely possible that for the next, 4 or 5 months, the Fed stands pat and you have general collateral at 430, 435, right? So you're funding at that level. Why would you want to take twos much lower than they are now at 428? What do you gain by it? Nothing at all. If you now take twos up to the 442 to 455 area and you basically fund positive 2030, you're quite happy. Why would you take fives much lower than this? Because what are you earning? 10 basis points of carry? Why would you do that? You know, it just doesn't make any sense to me that you would probe the downside. If the likelihood is that your data is going to be stronger, i.e. the economy performs better, it's more inflationary because of the tariffs, everything points to the fact that you really wouldn't want to bet that the Fed eases into it. And if you bet that the Fed won't ease into it, why would you have anything but a normally sloped positive yield curve in all tenures, from Fed funds out into the 30-year? Why? I just don't get it. I wouldn't want it. The yield curve, to me, and I've been saying this to you for months, has to go positive throughout every tenure. And that means at the SOFR curve level as well. So here we have my favorite, which is U25 against Z25. And as you can see, we are hovering, waiting to break to the upside. The SOFR spreads negative only make sense if you think that the Fed is going to cut at some stage. If you think now that they're going to be neutral and that they are neither looking to cut nor to hike, why would you have the curve at anything but zeros or positive? Positive, don't forget, and a lot of people are forgetting, is what 99% of the time the yield curve looks like. Now, I don't know whether it's 99 or 90 or 85, but who cares? What I'm saying is that the normal state of affair for all these SOFR spreads is positive. Now, it could be positive 2, 3, 4, 5. It could be positive 10. It could be positive 12. But it's the normal state of affairs. Positive, not negative. And if you now look at Z25 against Z26 and just compare this chart and that chart, they're identical, they just have a greater amplitude, which basically just means to me that you can afford to do 10 times as many of these as you can of those. But these are already positive, right? They're trading just above positive. And I think this one is going to 15. Just like I think that this one is going up here to at least 2-3 basis points. And then it's going to break it, and then it's going to go up to 6. To me, this 02 to 06 area is where this spread belongs if you think that the Fed is neutral, that the Fed is just as likely to cut rates as it is to hike rates. And I just don't see why that wouldn't be the case. To me, that is the case. The Fed needs now to see a lot of data before it decides which way it's going to move. Now, it's always possible that it gets that data earlier, but I wouldn't want to bet and remain with these spreads in negative territory. I think these spreads need to get to at least 0 or +1, +2, and then we see. This is a chart of TIPZ, which is the PIMCO equivalent of TIP. And as you can see, it's looking particularly ugly to me. This is actually where I bought it. 572 I paid for everything. And I actually sold it up here, 54.21, I believe, on that day. And I just dumped everything that I had. Now, to me, this looks particularly ugly, and it looks like it's going to break the 50.92 area at some stage, which would coincide with, I don't know, the data remaining strong in the US, i.e. NFP this week. You know, why should it be weak? There's absolutely no reason for it to be weak. Everything that we've had has always been strong in terms of non-farm weekly claims, and therefore I just don't see why it should happen this week, that we start getting weak data, and then Trump comes in hard with some tariffs, and the market starts panicking a little bit, and we go straight through these levels. Now, why do I look at TIPS, TIPZ, as opposed to TIP? Because it has a slightly longer effective duration. It's only 6 months longer. But you can see, if you do TIP over TIPZ, duration, right? I mean, adjusted, okay, this is adjusted for dividends because they seem to have different dividend policies. But you can see how we are trending higher in TIP over TIPZ, even with the adjustments of the dividends. It seems clear to me that the longer the duration, the worse the performance. And if you think of it that way, and we'll take out the adjustment for the dividends, this one, TIPZ, is going to lead TIP. So watch TIPZ as opposed to TIP, and watch it break this 50.89 area. And if you go back, this is all the way back to 2010 when it was initiated, which tells you that all you will have made owning it for 15 years or so is the dividends, nothing else. And we are back to where we were back in 2009. I think that when it breaks here, you want to start accumulating big time. That is going to be your signal that real rates are as high as an economy can possibly take it, I think. Certainly the US economy, which is so leveraged. At those very high yields, real yields, you really want to own it, because I am quite sure that at some stage it trades right back to the 200-day moving average. To me, that is sure, and that could be the time when you start seeing reversals in SPY, TLT, and such things. So I think you keep on watching TIPZ, you keep your powder dry, really to start buying a lot. 50, I would actually bet the house that from 50 it goes to 52.50. And that is a big move in percentage terms, certainly if you're levered. Germany is starting to feel the pull of the US. These are the twos, and don't forget the twos are the ones that have discounted most further cuts by the ECB. They're going to get some, I'm not sure they're going to get all, and that means that the yield curve, rather than steepening in Europe, is actually, going sideways. It advanced the steepening, and now I think it's not going to steepen as far as the US curve, simply because the twos, as I said, are already discounting a hell of a lot of cuts from the ECB. Now they're going to get some, but I don't think they're going to get all. And because the US is not a driver, and therefore everything is feeling the pull. Look at the tens look at the bunds. They're coming back to this 252, 257 area. And the markets that are really dangerous here are the French market, which is breaking out. And this could easily, with a little bit of turbulence in France, go to 366, i.e. make new highs on the whole move. Stay away. Unless you know something about French politics, stay the hell away. Now, Italy is also coming back to 368. And I would say that if France has a political nightmare, there will be contagion to Italy. The only reason why these spreads, and this is Italy against Germany, have come in as much as they've come in over the course of 2024 is the positive carry that you have in Italy over the Bund. Well, the positive carry can be taken away in a minute by a contagion move in this. And this chart just looks absolutely awful. Just continuous lower highs, which tells me that the moment a real crisis erupts in France, political crisis, you will get a monster move all the way down to here. And that's another 70 basis points. And that brings along with, contagion to Italy, contagion to Spain, etc. I just think it's not worth owning those for the extra little bit of carry that you get. I would much rather wait for this crisis to happen and then buy these levels than, bet that it won't happen. To me, that's a fool's bet. If nothing happens, you make 30 basis points. If something does happen, you lose 70. Not great odds. I would much rather stay in bunds and earn less and not have that kind of a risk that I'm carrying. But what I'm saying is that I don't think any of these markets are going up or will perform particularly well. I think all these bond markets are on the edge of doing something nasty, including the US, where I think these real rates could really spike up and spoil the inauguration party. Maybe not the inauguration party, but soon afterwards. So I'm very weary of bonds. I'd much rather own hedged positions where I know what my maximum loss is, because I think it's really going to be down to real rates spiking. And if they do spike, I think then that will be the signal that you want to really go in heavy on the real rates, possibly also in nominals via calls, because I don't think the economy can take that level of real rates, and I don't think equities are priced for them. So the differentials last week actually came in a bit. This is tens, not a huge move, a few basis points. But also what this is telling you is that it's tired. It's unlikely to start spiking higher without data. Twos actually came in the most, and that is because Germany has priced in so many easings into the twos. And now with the Fed where it is, as I've been telling you, it's not so sure that it's going to get all of them. It certainly is going to get some of them. The ECB needs to cut much more than the Fed needs to cut. In fact, the Fed never needed to cut at all. So do I think that this goes a long way down? No, I don't. But also what it's telling me is that it's a range for now. And that colors my view of what the dollar is going to do. Having reached 109.29, which was my ultimate objective for this move, I think the dollar is ready to take a little bit of a rest and stop being such a huge wrecking ball. Why would we not rest here? and wait and see what the Trump policies are. Some people think that Trump wants a lower dollar. He probably wants a lower dollar, but how's he going to get a lower dollar? So it should be enough, this uncertainty of what the policies are going to be. We all know that he's going to bring in tariffs, but at what speed, to what extent, against who, etc., etc., should be enough to give the dollar a little bit of pause. And especially the fact that we are now getting normalization in the US curve, and also a little bit of uncertainty about how far the ECB will cut. So if we have a look at this chart of the Euro USD, it achieved 102.06, and now let's see if we can spend a couple of weeks between 102.06 and 104.38. Why would that not make sense? To me, that would make perfect sense. It still will be in a downtrend. It still will ultimately really probably go down to 96 or even lower. But pushing it now, I find that difficult. It just doesn't make any sense to me that we should really go down now. I would like to be somewhere here for Inauguration Day. Let these moving averages catch up a little bit, the dailies. We are a long way away from the daily moving averages. Let's be, 104, 104.50 for the inauguration and clarification of what the Trump policies are. There's going to be a divergence here, which tells me that potentially we've seen the low for the next 2 weeks, let's call it. I'm still bullish dollars because I don't see what Trump can do to weaken the dollar. I'll wait and see. I'll wait for the policy. I'll wait for the announcement. But until then, I really want to be neutral and looking to trade it much more than position it. I've made a lot of money from about here to now here. I'm now square. I don't want to know about the dollar for the next couple of weeks other than trading it for 20, 30, 40 basis points. The currency that Trump would want the dollar to weaken most against has to be the yen, if not, when we're not talking about China, but of the developed markets, the ones that I trade, you would have thought that it would be the yen. And here we go, this is euro yen. To me, it makes sense that every time we go to the 200-day moving average, you have to sell it. And really you are looking to cover it around this 158 area. It seems to be where we are, even on the weekly charts, that we are stuck between 158 and 164. And this trading range should continue until we know what the policies are. And then I think we break down. And where would that break take us? Well, it would take us all the way to the 200-day moving average around this 146 to 145 area. And funnily enough, this corresponds to my view in gold as well. If you actually look at that chart of euro and the Japanese yen, it's very similar to this chart of gold. Now, if I think that real rates are going to spike higher and that the dollar is going to go sideways for a bit, you have to think that gold is going to do at best a sideways motion. But when real rates spike, would it not make sense for gold to actually break the 200-day moving average and stop everyone out by having a big one-day move all the way to, I don't know, 2450? I have no idea. I'm just saying, if you start breaking these levels, the 2600, and say you come down to 2580, everybody will be buying it, right? Because it'll be the 200-day moving average. It'll be, here, everyone will love it there. And then all of a sudden, boom, and it goes down to 2400 or something as the real rates spike. And as I've told you, I would want to buy heavy that real rate spike. And what happens then? Then gold just goes parabolic from here. To me, that would make sense, and that's why I am still waiting to buy gold lower, because I want to see this real rate spike and its reaction. I think it's just too easy to buy it here, just too easy. The market is going to punish those people with a quick $100 move down and stop them all out, and then it goes up. To me, that is the only thing that makes sense. GSG actually had a good first week, but it really means not a lot until we start breaking 23. After we break 23, and that could be the reason why real rates spike, right? What is everyone saying? Commodities are going nowhere, we're not going to get any more inflation, blah, blah, blah. I've been saying it for a long time, and it's been happening for a long time. But what if now we start breaking 23 and we immediately go to 24.57 and we have this big move in commodities? Well, then people will not be so sure anymore. In fact, they'll be saying, look at commodities. And that is when you get the spike in real rates and you get the real steepening to the levels that I was talking about in 2s10s, 2s30s. And that would probably be it, 24.50. So look for commodities to actually start doing a little bit better, go up to 24.50 and come straight back down to 21. That would be the scenario that I see as most likely. Well, the 58.65 level held great. Every time we tried to stop everyone out below it, straight back up. You know what I'm going to say. Until we see a daily close below that 58.65, you can only be neutral when we dip, and you can only be neutral when we rally. So if we enlarge the 1 month chart on support of the monthlies, and it's been extremely rare that we've closed below. We are on support from the moving averages on the weekly, and it's very, very hard for me to see that we go below it without data. So what I think is most likely is that we rally to this 6,003. If you add 50 for SPX ES relationship, you're looking for 60.53, whatever. 60.40s, you already want to be buying puts, because I think that we are in that range, 58.65 to 6,003 for quite some time, certainly until Friday. I just can't see that we are going to be any higher than that by Friday, and then we see on the NFP. I still prefer equities to bonds, but there is a limit to all preference, because when real rates spike, and if they do, I don't think that equities can hold 58.65 any longer. But it's a long way away. I mean, when I say a long way, it could be 2, 3, 4, 5 weeks away. What is the point of thinking about it? We have to be prepared, and that's why I'm prepared for the spike in real rates. And I have my levels written down where I'm going to buy a shitload of tips. But in the meantime, I'm going to just trade this market, 58.65, 6,003. Up here, I just buy puts. The averages that are most affected, it seems, for the time being, by what the bond market is doing, and that is the steepening, that is the term premium going out, that is the real rates being dragged by term premium higher, seems to be the Dow and also the small caps. The one that really isn't being affected for the time being, the NDX, where all the big Mag 10 are concentrated. And this chart looks far more bullish than the SPX chart or even the Dow chart, and certainly the Dow chart. Where did it stop last week? Exactly where I said, 2750. It could not even attempt that level down there, and straight back up, and now probably back up to this kind of level, 21,600. Quick dart up, fill the gap, come back. I doubt that we're going to be very far away from here by the end of next week, unless rather the NFP is much stronger than expected and bonds do something on the back of it. But again, I just don't see why that would be. It seems to me that NFP is going to be more or less in line, because every single weekly claim has been in line. You've had 3 slightly stronger, you've had 1 slightly weaker. What is there to really write home about and look forward to in NFP? I think it's much more likely that we get surprises in CPI than NFP, certainly this month. I certainly could not understand last week why everybody was getting so excited about the stock market and where it was going to go. To me, unless volatility closes above this 2060 area, you have absolutely nothing to worry about from the stock market. Look where we closed. 1, 2, 3, 4. We closed exactly where we opened, basically, in terms of volatility. Volatility is telling us that we're going sideways in the stock market for now, and only closes above 2060 tell me that we have anything to worry about in terms of immediate moves in the stock market. I think it's going to be a boring, slow week until NFP, and then we see. I've updated the very few levels that needed updating. My messages really are: stay away from OATs and stay away from any asset which might have contagion to France, i.e. something like the BTPs or whatever in Europe. I just don't think it's worth owning. I think all the bonds are in dangerous territory, and I think the odds of a spike in real rates, and I told you to watch TIPZ, the odds of a spike in real rates driven via the term premia is still something that I think is much higher than the market anticipates. What's going to cause it? Who the hell knows? It could be a Trump tweet for all we know. But I think that we are in dangerous territory, and that at some stage, and most probably not next week, in fact I'm pretty sure it's not next week, but later on you have to watch for this spike in real rates. And when it happens, be prepared to take advantage of it. That is the time when the stock market could start breaking down, and that is the time when volatility could start getting really bid. I think volatility is going to tell us in advance when that happens. You start getting 2060 closes, something is happening. Until then, we're quite sleepy, and basically we just trade the ranges. Thank you very much indeed, and tweet you tomorrow.